As I hit upload on my last video, something wild happened. The odds of a September Fed rate cut did not just jump, they doubled. They rocketed from around 40% to over 80% in a single day. Normally, that is the kind of news that sends risk assets to the moon. But this time, the market went straight to the shithole, and it continues to dump. So, are we going to claw back for a final August relief rally before the Rectember, or are we doomed to chop sideways and bleed out until October? In this video, I am cutting through the noise and will break down the major macro developments that have the market terrified. I will also explain exactly why this fear is creating a massive opportunity and reveal my high-conviction altcoin watchlist with the exact levels I am bidding. If that sounds good, hit like to support the channel and subscribe if you haven't already. Let's get straight into it. The market sentiment has been pretty unusual. While an interest rate cut typically sparks bullish momentum, this time prices slid further. That's because traders aren't viewing this as a normal, forward-looking move to boost growth. Instead, it's coming across as a desperate reaction to mounting economic weakness. The motivation behind the cut is spooking people more than the actual cut itself. This is textbook bad news is actually just bad news, highlighting how shaky and unsure sentiment remains right now. It's a clear sign the market still sees plenty of underlying risk. The fear in the market isn't just panic, it's rooted in real macro concerns. 4 key things are spooking investors. A weak jobs report that's become a political football and sticky inflation that's limiting the Fed's options. Add to that fresh tariffs that feel like attacks on growth and growing noise around the Fed losing its independence. The first shockwave came from the July non-farm payrolls report. The headline number was a disaster. Just 73,000 jobs added, way below the already modest expectations of 110,000 to 147,000. But that's not even the scary part. The real horror show is in the revisions. May and June numbers were quietly slashed by a combined 258,000 jobs. That's not a revision, that's a confession. It basically means the economy created almost no jobs for 2 straight months, a level of weakness we haven't seen outside a full-blown recession. This disastrous economic data was immediately followed by political fallout. Just hours after the report's release, President Trump fired the BLS commissioner, Erica McIntyre, a Biden appointee. He publicly accused her of manipulating employment figures for political purposes. This action injects a massive dose of uncertainty into the market. It is an attack on the credibility of the very data that markets rely on to make decisions. If traders cannot trust the data, risk premiums must increase across all assets, especially speculative ones like crypto. The Fed is trapped in a brutal catch-22. The labor market is breaking down with the latest jobs data screaming for immediate rate cuts, but sticky inflation is refusing to budge. Core PCE came in hot at 2.8%, wage growth is accelerating and price pressures aren't easing. The Fed's dual mandate is now in conflict. Employment needs support, but inflation demands restraint. This paralysis is spooking markets, and crypto is catching the heat as traders price in a Fed with no good options. The Fed's dilemma is being made worse by a new wave of U.S. tariffs that kicked in on August 1. Furniture, appliances, and even computers saw sharp price jumps in June. A 50% tariff on copper is now live too, adding pressure on key sectors like energy and defense. This is not just inflationary, it's macro instability. The Fed is not only caught between a weakening labor market and sticky inflation, but is now facing intense political pressure that threatens its independence. Rare dissent within the FOMC has already emerged, with 2 governors voting for a rate cut in July. Shortly after, Governor Adriana Kugler resigned early, giving President Trump a chance to install a loyalist on the Fed's board, possibly even a future Fed chair. This adds a new layer of political risk to monetary policy, further shaking market confidence at a time when inflation, trade tariffs, and labor weakness are already creating chaos. After breaking down the macro fear, it's time to check the blockchain for the ground truth. That fear-driven sell-off triggered a brutal but necessary leverage flush. In just 24 hours, we saw over $630 million in leveraged positions get absolutely wiped out, with nearly 90% of them being overeager longs caught on the wrong side of the move. While painful for some, this is a healthy reset. It purges the speculative froth from the market and builds a much cleaner, stronger foundation for the next leg up. We've seen this play out before. A massive liquidation cascade is often followed by a sharp V-shaped recovery. Right now, Bitcoin bounced strong from the 112K level and printed a solid green candle on the daily. This is exactly where you want buyers to show up. In my 8 years in crypto, one thing has worked time and again. Dollar cost averaging into these fear-driven sell-offs delivers. I've always believed in buying the blood and scaling out on strength. If you've got dry powder, this isn't a bad area to start nibbling. And if you don't, the worst move right now is panic selling. When we look back at this dip later this year, most will wish they had acted. In times like this, clarity matters. Instead of betting on one outcome, the smarter move is to map out the highest probability paths and build a flexible game plan that adapts as things unfold. There are two likely scenarios for the next couple of months. In the bullish case, we've already seen the worst of the panic. Leverage has been flushed, the bad macro news is mostly priced in, and the market starts front-running a September rate cut. If this plays out, we'll get a solid recovery through August, with Bitcoin reclaiming key levels and altcoins bouncing hard. The bearish case is that macro fear continues to dominate. In that scenario, the market either chops or bleeds slowly through August, failing to gain any real momentum. Then comes the classic September dump, a seasonal flush that shakes out the final weak hands. Bitcoin could test the 100K zone before setting up for a proper Q4 reversal. Which scenario do you think plays out? Drop your thoughts in the comments. I always enjoy reading different perspectives. Now let's talk about my personal plan and how I'm navigating this. My strategy is straightforward. I'm accumulating high-quality altcoins right now, but I'm not going all in. This is a phase for patience and smart scaling, not full deployment. The key is to stay unemotional and buy fear, not greed. That means adding on red days and avoiding the temptation to chase green candles. This strategy ties directly into the two market scenarios we discussed. If the August rally plays out, I'll take partial profits on my current positions to reduce risk and lock in gains. But if the market stays choppy or we get the classic September dump, I'll DCA into my highest conviction plays. That way I use any panic as a chance to accumulate before a potential Q4 rally. Alright, now let's quickly go over the altcoins I'm planning to accumulate in this dip. I'll keep this part brief and just highlight the coins along with key buy levels. A full dedicated video is coming soon, where I'll break down my entire blueprint for scaling in, including exact entries and exits. Make sure you're subscribed so you don't miss that crucial upload. The first altcoin I'm planning to accumulate is ETH. I already trimmed some of my position around the 3,800 level back in July. ETH is still the undisputed king of layer ones, but it's been showing signs of exhaustion after failing multiple times to break and hold above the key 4,000 resistance. This current pullback is a solid opportunity to build back in. I'm eyeing the 3,000 region for a light entry, but I'm not in a rush since I still hold a decent chunk. If the market goes full meltdown in September and we see ETH around 2,500, I'll be bidding aggressively. Next up is SUI, a fast and scalable layer 1 blockchain that's currently under heavy selling pressure due to a token unlock. On August 1st, over $210 million worth of tokens were released into circulation, accounting for around 1.65% of its total market cap. Events like this often trigger a dip, as early investors and team members take profits, opening the door for fresh accumulation. My bids were filled around the 3.35 range, which is now my average entry. If the price drops further, I'll continue scaling in, since I believe SUI has strong upside potential once the broader market turns. This remains one of my high conviction bets for this cycle. Let's move on to the next one, which is a short-term flip. My bids on Altcoin finally hit last night. I had layered orders around the 90-cent zone, and that sharp dip gave me the entry I wanted. To be clear, this isn't a long-term hold. The daily chart still looks rough, with most indicators flashing sell signals. But in times like these, I don't mind taking small, high-beta shots. If the market bounces, this could easily push back toward $2. But I don't plan to hold that long and will likely take profits much earlier. If we bleed further, the next key support is near 70 cents. I'm not going in with serious size, but if we wick that low, I might add a bit more. It's a high-risk, high-reward setup, so size accordingly. Next is Pengu, which has evolved beyond just being a meme coin. It's building into a strong brand backed by a highly engaged community. The token saw an explosive 340% move in just a month, and it's now cooling off in a healthy consolidation phase. This is the time to identify key support levels for the next potential leg up. The previous run was clearly overheated, with the RSI hitting 86 deep in overbought territory. Price is now hovering around the 0.034 zone. Personally, I'm eyeing a small entry around 0.03, with another layer set closer to 0.023. To wrap it all up, the market is bleeding because of a perfect storm of macro fear. A jobs report disaster, sticky inflation, escalating tariff wars, and political games at the Fed have created a peak uncertainty environment. But when we look on-chain, the long-term bull thesis remains firmly intact. This disconnect between short-term fear and long-term fundamentals is our opportunity. The coming weeks will likely be choppy, but they are a gift for anyone with a plan and dry powder. This is the time to be strategically accumulating, not panic selling. Remember, fortunes are made when you buy what others are fearfully selling. Be greedy when others are fearful. This is not financial advice, but this is my exact game plan. Thanks for watching, stay safe out there, and I will see you in the next one.